Good morning, everyone. Thanks for joining us at Capstone Coffee Conversation today. As we kick off 2023, it feels weird to say that still, but as we kick off 2023, we always like to look back on last year, look at what went really well, what we're happy about from last year, and then maybe some things that we can improve on. What were some surprises? What did we get wrong? And so how can we kind of fix those and remedy that for potentially the next year? And then also we'll look ahead for 2023 and kind of take what we've learned from 2022 and how do we incorporate that for next year, look at what this particular year might bring and how we're trying to tackle some of the challenges and potential headwinds, and then also what maybe some things that we're excited about. So I always forget to say, but if you have questions, please message the host. You can click on your Zoom. You can hit a little button that says chat with the host and send a message, and Kennedy back here manning the computer will take questions at the end, and happy to talk about what you want to talk about and what you're thinking about. And then as always, we can have individual conversations later, but feel free, please hit the chat button to the host and we'll cover those at the end. So last year, 2022 worked out to be we've talked about it throughout the year. We've kind of belabored the point probably a little bit, and the media definitely has let you know, but it was a very challenging year for both the stock market and the bond market collectively. In fact, collectively, the worst year for stocks and bonds together. It wasn't the worst stock year by any means, but stocks and bonds collectively, it was the worst year in investing history. So very challenging year, and we've made it though, so it's not, we're not through all of it. Today's not the bottom potentially, but we have kind of weathered a very difficult storm of 2022. And so we'll talk about that. Number one, what went well? So the things that we felt most proud about or happy about for 2022 is we really leaned towards the right areas of the market. It doesn't mean necessarily that all those areas made money, but there were some certain areas of the stock market that were closer to flat. Some made a little bit of money, some maybe lost a little bit of money. And those areas we've talked about a lot, but owning the value area of the market. So financials and energy types of companies, dividend paying companies, that area of the market held up much better. So that was, we really leaned there and kept continuing to do that more so throughout the year. So holding the right types of stocks for 2022, we felt like we were in that position. Again, it doesn't mean it made money for you, but it helped definitely prevent some of the major losses. We also held a healthy portion in international. And international, again, didn't make money last year, but it actually did better than the US stock market by about 4% last year. And so leaning towards the right areas, we kind of feel good about that. That went really well. What didn't go well last year for the stock market is, number one, markets were way down. Even the value side of the market wasn't great, or international was down. But the growth side of the market, the technology companies, did much worse than I think anybody, or did much worse than I expected them to. When you have companies, and I just wrote down a few of them, Microsoft down 30%, and these are really rough numbers, but Microsoft down about 30% at some point through the year last year. Amazon finished the year down about 50%, right? So the company that everybody drive by an Amazon truck every 30 seconds, you see a new distribution warehouse every time you go through kind of industrial areas. That company, Amazon, was down 50%. Tesla down 67%-ish last year. So you have companies like Microsoft losing a quarter to a third of its value, Amazon losing a half of its value, a company like Tesla losing 2/3 of its value in the market last year. Facebook lost about 80% of its value. At one point, Netflix was down about 80% plus in its value. Disney's way down. Companies that people wanted to own going into last year were down 20s and 30s and 50s and 80% last year. So that's much more than I think we would have put a figure on that. And so that area of the market did very poorly, and that drags down the entire market. Microsoft, Amazon, Tesla, those are big portions of the market in general. So if you own the market in general and you say, oh, let's buy the S&P 500 and we'll just own a little bit of everything, those companies really drug down the market index. So that was very challenging. We kind of anticipated choppy investment years, and that's kind of what the value index gave us. The value companies were choppy, didn't make very much money, didn't lose very much money, some ups and downs, but the growth side of the market was not choppy. That was a free fall, right? Now, the good news is we were getting out of as much as possible your Amazons, Microsofts, Teslas. So we held very little in those areas, but even holding very little in companies that go down 25, 50, 75%, that made it very challenging. So kind of the good news, we felt like we leaned toward the right areas. The bad news, the areas that we still hold a little bit of, or the market in general, were way down. So that was 2022, and I'm sure we've all kind of belabored that point throughout the year. On the bond side, what went well, staying very short-term and high quality for our fixed income did better than being long-term or even lower quality fixed income. So entering the year last year, if you recall, interest rates were very low. So we stayed very short-term on fixed income. That really helped. But even short-term bonds lost money last year, right? They didn't lose as much money as long-term bonds did, but even short-term bonds lost money. And so as we look at, well, on the bond side, so what can we learn from 2022? On the fixed income side, and this is something that I want to do a better job at, which in turn means I have to do a better job of educating clients about. Sometimes no return is better than a negative return. And that can be challenging because nobody wants to sign up for a 0% return. But last year, entering 2022, the risk reward for bonds the reward was very small. Even if interest rates stayed flat, your return could have been 1, 2, or 3%. But if interest rates shot up like they did, then all of a sudden our bond return can go negative. And so understanding that the risk reward trade-off for fixed income last year, even though we held short-term bonds much better than long-term bonds, the better alternative to short-term bonds would have been cash at 0. And that's something that I need to continue to review and then also educate clients about is, hey, we might have some investments that their job is just to hold the line, and we're not going to try to earn 1 or 2 or 3%, but we're going to try to stay neutral in this portion of our portfolio, be a little safer. And sometimes that means accepting a lower return, but in an environment like last year, a 0 was better than our short-term income, which ended up with about a -4, right? And so that's one thing. Same thing with on the stock side, the risk reward for those technology companies like Microsoft, Amazon, Tesla, Apple, which had done so well for many years, and people made a lot of money, and people start to think, well, these are impenetrable. Microsoft always is going to go up. Amazon's always going to make money. Look at that, right? I'm using Amazon every day. It can't go down. Yes, it can, right? And so being able to have that conversation with clients and saying, hey, this has made a lot of money for you in the past. We're not going to hold it anymore. And taking a little bit more of a strong arm in that in some regards. There are ways that we're kind of learning to continue to try to better our portfolios, but it means educating. It means also helping clients understand that sometimes, shooting for our target return, maybe sometimes we have to shoot for a little bit less than target in difficult years, right? So that's 2022, kind of as a recap. Stocks, we kind of expected choppy. Some areas were choppy, but some areas were way down. Fixed income, we stayed very short term. That was helpful, but cash was even better than short term last year. So as we look at 2023, how can we incorporate some of what went well and some of our lessons that we learned, and what does 2023 look like? So 2023 is still going to be a challenge, and we're already feeling that, right? We're 10 days in, or 11 days in, 10 days in. After Christmas break, I have to continue to check my watch to make sure what day it is. We're 10 days in to the new year, and we're already sensing some of the challenges. we would continue on this, a lot of the same themes, but we do think this year will be somewhat of a transition year. Okay, and so what do we mean by that? Number one, the Fed starting to slow down its rate increases. Throughout last year, it really ramped up rate increases, and that made it very difficult for stocks, made it very difficult for bonds. There's probably another one, maybe two rate increases, maybe three, hopefully one. But then they'll be done. The Fed will quit raising rates. That will start to be beneficial for stocks and for bonds. And at some point during the year, the Fed might even lower rates, right? Which can get then helpful for stocks and bonds. So a transition at some point during this year. Our base case is also calling for some type of a recession this year. So a recession can mean a lot of different things though. So let's kind of talk about that. Number one, the Fed is trying to engineer what we call a soft landing, right? So a recession where unemployment goes up a little bit, but for the most part, the economy keeps kind of clicking on full cycles, but it's back to normal. Right now, we're at very low historically unemployment levels, right? Too low, honestly. And that's why the Fed is raising rates. We're trying to get more to an equilibrium in the economy where we can have growth without overheating. And so our base case this year is for some type of recession, hopefully a soft landing, but we could see some difficult times in the next, call it 3 to 6 months still, where the market's very choppy, sometimes some very difficult, maybe a difficult quarter followed by another rally. We've seen that over the last 3 to 6 months. We've had difficult months followed by some upswings. And so our base case is kind of continue for the first 3 to 6, maybe even 9 months of a continuation of 2022, where we stay on the value side of the market. Even though Amazon's gone down 50%, I know this is funny math, it can go down another 50% and it can go down another 50%. And you think, well, that's 150%. But it's like the frog that jumps halfway across the street and then jumps halfway again and jumps halfway again, and it never gets across the street. So just because a company is down 50%, it could do the same thing over again. Okay. And so we're still in the frame of mind of being in companies that pay a good dividend with great cash flow, and what we would say are a little bit more recession friendly. No company likes a recession, obviously, but there's certain areas of the market that hold up better and can make some money in difficult environments. And so that's where we're continuing to lead the portfolios toward. There will come a time where Amazon, Tesla, Microsoft, at these deep discounts from last year, might become attractive again. We're not quite there yet. Okay? The Fed raising rates is basically taking money out of the system. Okay? And when you're taking money out of the system, it's going to continue to slow down earnings. And a lot of those companies that really did poorly last year were priced for perfection. They were the companies that they can't ever go down. And lo and behold, like we saw last year, they definitely can. We would say the market today, the stock market in general, is fairly valued. So fairly valued in a all things being equal would mean average returns. But fairly valued, if you're anticipating some type of recession coming, would mean we're slightly expensive. Okay, so if the market today is fairly valued and we see earnings going down over the next 3 or 6 months, well, then that would lead us to slightly elevated market prices. And I know that's kind of hard to hear sometimes. We don't want to hear that the market's expensive. We want to hear that things are going to do very well from here. But if we can take that information and that leads us to a better allocation, then that's what we're trying to do. So fairly valued today, but we're expecting a slowdown, some type of recession, which would mean we want to be somewhat safe in our portfolio with the types of stocks we hold. Okay. It also would lead us to continuing to invest outside of the United States. The international markets have fallen harder and farther than the US markets, and so have better price points. And kind of just the same point that we learned from the last year, what you pay for a company matters. So even though a company might still be here and doing very well, a la Amazon and Microsoft, If you pay too much in the stock price, you can lose money. A good example that I use consistently is from the year 2000 to 2010, Microsoft was an excellent company. The stock price went down for 10 years. From 2000 to 2010, and granted, it wasn't just a straight line, it was down and up and down and up. But if you bought Microsoft in 2000 and you sold it in 2010, you lost money. Microsoft was a great company for that decade. Okay? But if you bought it in 2000, you paid a lot. And in 2010, it was worth less. Okay? So we're trying to lean the portfolio to kind of the same areas as we start 2023, as we finish 2022. The second component, this year, we don't want to be afraid of bonds. We actually like fixed income today. Look at today's interest rates. You can look at mortgages. You could look at a car loan. Interest rates today are dramatically different than they were a year ago. They are much higher, right? Well, think of yourself when you own a bond, you're the one getting paid those interest rates, right? You're the owner of those bonds. Somebody's paying you the interest. So today's rate, if you hold the bond, is dramatically different than last year at this time if you held the bond. You're getting paid to hold bonds today, okay? And so adding or holding some fixed income at 4, 5, 6, even 8% for fixed income in certain areas is worth it. That is a good risk reward. So we are staying a little bit safer today with our stocks, being more cash flow, dividend payers, and we're taking some of that stock money and we're holding a little bit more fixed income. Yes, that when we hold fixed income over stocks, over time, that is signing up for a lesser return, right? But as I just had mentioned, sometimes signing up for a lesser return that's more predictable in a very challenging year is a good trade-off, right? Signing up for a 4, 5, or 6% return in fixed income, yes, our average return in stocks is 10 or 11, but entering into this year, I think an average of 10 or 11 for the first 6 months in stocks will be challenging. So taking some of that stock money, signing up for a lesser return in fixed income that's more predictable with good cash flow is a good trade-off, okay? Last year, the balanced or the 60-40, you'll hear it, or 70-30, the balanced portfolio didn't work, right? Holding a combination of stocks and bonds gave you the lowest possible return last year over history because stocks and bonds went down together. And so you see a lot of articles, people speak to, you have to rethink your portfolio. You have to rethink everything because it didn't work last year. And I would counter that. And I would say, no, you don't. I think going forward, the balanced portfolio or the 60-40 or the 70-30 portfolio is actually better set up to work for the next decade, much better than it's been set up to work for the last decade. And that all comes back to the interest rates that you're returning on your fixed income. We're getting back to a more normalized investment schema, more normalized, where you actually get paid for fixed income and stocks are fairly valued, right? COVID will be less of a thing going forward, et cetera, right? Where for a time, the last decade, you got paid nothing for fixed income or very low, and money was being thrown at the system. The Fed kept rates at 0, and so you had all this run up in stocks. Bonds made you nothing. Well, that kind of blew up last year, right? We aren't recreating history, right? We're getting back to a more normalized investment universe where bonds pay something, and there is risk for stocks again, right? The Fed is taking money out of the system. It's not just you can't just put money into anything and it goes up in the stock market. We're getting back to a more normalized scenario. And so that balanced portfolio, that 60-40, that 70-30 actually we are in a really good position today for the next, call it 3, 5, 10 years than we were a decade ago with a more normalized portfolio. The other thing that we're doing this year to in portfolios is adding some pieces that are different than stocks and bonds because of this challenging environment, namely commodities. things that can perform well in high inflationary environments. Even if we think inflation has peaked and hopefully doesn't get above the 9 that we saw last year for inflation, right? We're somewhere around 7 today and hopefully going down. But even if inflation gets down to 4 or 5 over the next handful of months, it's probably not getting back to 2 for a while. So 4 and 5% inflation is pretty high, historically speaking. It's really high over the last 10 to 20 years, right? And so owning investments that do well in inflationary environments, and so things like that I'll just kind of name a few of, would be owning objects you can taste and see and touch and what have you. Gold, silver, oil, agriculture, lumber, livestock. And so adding commodity type funds where when the price of stuff goes up, you are benefiting from the inflationary environment by holding hard assets, we would call that, right? So sprinkling that into portfolios is not something that we typically will always hold throughout time, but in this type of environment where stocks are still in a challenging area and inflation is running elevated, that is a good portfolio diversifier in this environment. So the things that we're looking for when we think that the green light can come back on and we are more in a risk on environment would be the Fed starts to lower rates. We don't have to get through a recession for the stock market to start to do well, but we need to get a little bit through, the beginnings of a recession. The stock market is a forward-looking instrument. So last year, the stock market started to go down early in the year before the economy felt any pain, right? And so this year, we could start to have markets improving while we're still in a difficult environment for stock or for the economy, for GDP. So that's kind of what we're looking for. Is we feel like we're in a bottoming process right now. Bottoms can take time to form in the market. We're trying to lean towards recessionary proof investments, adding fixed income, getting paid to wait through this environment, and sprinkling in some inflation proof type investments like commodities. Not necessarily inflation proof, I don't want to use that word. They don't always go up in that time, but a diversifier in that regard. So all in all, 2023 hopefully will be a transition year. We'll probably have a little bit of pain with some good times as also, but at some point we probably will see the Fed start to back off, lower rates, markets start to improve, and hopefully we can be somewhere at if I look at the entire year, hopefully we can be somewhere of a average return, maybe even a little bit less than average. Unless we have something really go awry, I think something like last year will be hard to repeat. We aren't expecting a 2008. We don't think this is the financial crisis. Companies are very healthy. Profitability is down as costs go up, but we aren't seeing a 2008 financial crisis type of environment. So that's how we're starting to start the year in our portfolio allocation in 2023. But we will probably see some transitions this year, and as we start to hopefully see some turning in the economy. With that, I want to hear from any of your questions and kind of how we're allocating and anything that you guys have on your mind.
It looks like we had one question come in, and the question is, if the market is going to be challenging this year, should we move to cash and wait for the market to improve?
Good question. Okay. And that is, we try not to be traders. We attempt to be investors. And just because we think, okay, this year could be challenging and this and that and the other, if we were 100% sure what would happen, we would be 100% into one investment, and then when things look like they're going to change, we'd be 100% into another investment. But I think the best route to be an investor over the long term is to lean a portfolio to areas that you see at a good value. And we do think there's good value in those dividend payer, high quality cash flow companies still today. So even if the areas are challenging, then like overweighting those types of areas. We're definitely leaning away from some areas, but some of the best returns come off of bottoms. And you saw that in October and November. Portfolios did very well for 2 months there after what was a very challenging August and September, right? And it looked very bleak through September. And then all of a sudden, even though not much has changed between September 30th and October 1st, the market took off and did really well for 2 months. So off of these bottoms, which we think we're beginning to form, are the best returns in the market. And if we're sitting in cash, and even if you miss 2 weeks or a month or 6 weeks of that recovery, you missed most of the return up, right? And so that's where we want to lean the portfolio, but we don't want to try to be a trader where we're timing the market all in or all out, even in this environment. Good. All right. Next month, we're actually going to have a guest speaker on, and we're going to talk about the real estate area of the market. We've added some real estate to some portfolios. Real estate is kind of being like a commodity, a hard asset, right? That can do well in an inflationary environment. Probably also waiting for the Fed to quit raising rates. Real estate's had some type of decline, but this year might be a reversal also if the Fed starts to lower rates. And so we're going to have a guest speaker that helps us in managing a real estate fund that will be on for next month. And as always, thank you for joining Capstone Coffee Conversation. I look forward to chatting with you soon.